Good day, and welcome to today's lecture on Chapter 4, which deals specifically with tax planning, how we go about calculating taxes using the marginal tax tables, how we go about using the IRS 1040 in Schedule 1 form, as well as we'll wrap up the lecture on tax planning strategies and how we go about effectively planning for taxes in the future. So with that said, let's go ahead and get started with Chapter 4. So today, what we're going to be discussing relates specifically to federal income taxes. Okay, we are not going to be discussing state taxes at the moment, but we are going to be discussing at length federal income taxes today. So what I'd like to do is go ahead and get started with the lecture. So we have 5 learning objectives for today. The first learning objective is we're just going to simply go through and describe what the importance of taxes are for the purposes of financial planning, okay? Because like it or not, they are a necessary evil. We must pay Caesar what Caesar is due, and we have to learn how to effectively plan for that within the personal financial statements that we discussed last week. The second learning objective for this lecture is we're going to learn specifically how to calculate taxable income. What does that even mean? What is adjusted gross income? How do we calculate taxes based upon that? What are exemptions? How do we factor in exemptions that the IRS allows us to take? We'll go through a little example of that within Excel. And then we're literally going to step through how to go about preparing a tax form. Many of you will probably wind up simply using TurboTax or H&R Block in the future, an online tax preparation service. But for this course, it's very important that we understand how those numbers, how our income and how our deductions are taken into account within those electronic services, okay? So that you have a better understanding of how taxes get calculated, and whether or not you should expect to get a refund or whether or not you're going to maybe owe money to the federal government. Also big considerations to take into account. So that'll be our third learning objective. And we'll spend a lot of time just within the 1040 and within Schedule 1 so that you can see what I'm talking about, because the assignment for next week will be the submission of a completed 1040 in Schedule 1 based upon a sample case study that has been posted to our learning management system. The fourth learning objective, we'll just talk a little bit about what are some of the resources that are available to you in terms of how to go about getting tax advice. In my line of work, I'm an investment advisor representative and I own an RIA. We do not provide tax assistance. Okay, we do not provide tax advice. It's a very clear delineation between companies that are permitted by law to provide tax advice versus an investment advice. So when we talk about obtaining tax assistance, I can provide you some guidance, okay, and maybe with someone who to talk to if you're in need of this, but I personally am not capable of providing actual advice on the subject, but I can teach you. Okay, and then the final learning objective is we're going to talk briefly about some tax strategies for your personal financial situation that you might find yourself in. So with that said, let's go ahead and get started. All right, so our first learning objective is we're going to try to describe the importance of taxes for how we go about planning. Okay, so in general, and this is very true, even at your level of income, about 1/3 of every dollar that you bring in the door, okay, gets paid out in the form of taxes, right? So what does this mean? Basically, it means that by, let's say the middle of April, first part of April, okay, right around the time that taxes are due, okay, that all of the money that you made from a gross income standpoint, all of the money that you made from January 1st, okay, up until that point in April, so about 1/3 of the year, okay, all of that income, you worked all of that time simply to pay your full year tax obligation. So we kind of call this day in April Tax Freedom Day, because every day that you work after that is pure money into your pocket. So you work approximately a third of the year simply to pay the taxes that you're going to owe. So put that into perspective a little bit. Okay. Some of the common goals that we like to talk about when we're looking at taxes from a planning standpoint. Okay. First of all, you got to know the current laws, right? And you got to know which regulations impact you. All right. Now, I'm not suggesting that you go to the IRS website and you read every single possible tax code that they have published, because you fall asleep really quickly, and it's about 100,000 pages long. Not really, but it's significantly long. But you need to understand the rules and regulations that apply to your current situation. And as you move through that life cycle that we talked about, you need to understand how those rules and regulations change so that you can practice proper tax avoidance. Not tax evasion, that's illegal and you go to jail. But tax avoidance is a practice that you should practice. You should understand the rules and regulations so that you can take advantage of all of the things that are available to you in order to avoid having to pay as much tax as possible. Okay, so again, big delineation between tax avoidance, legal, versus tax evasion, not legal. Okay, so don't practice tax evasion, but do practice tax avoidance. Okay. When we talk about making purchases and investment decisions, we need to factor in those decisions as to how those decisions relate to our tax liability. Okay, and the timing of when we make those decisions, because maybe putting off that decision until the next year is more beneficial to you, okay, to take that deduction next year instead of this year. Right? And so that's when we get into planning for our taxes. Right? Now, for the first few years, after you graduate, this is not really something that you're necessarily going to have to pay attention to, okay? But in short order, after you graduate, within probably the first 5 years, this is going to be something that you're going to have to keep in mind, how you go about planning your taxes. So when we talk about tax, what are we really talking about? Well, we got 4 different types of taxes that exist. Okay? We have taxes on the things that we buy. Right? So we have a sales tax and we have an excise tax. We have taxes on property. Okay? So real estate property tax. We sometimes have personal property tax. Like I have to file a personal property tax return with the state of Maryland because I own my own business and I work from my home. Okay, so I have to file an additional form for that each year. We have taxes on our wealth, right? Another one of the most common ones that you are familiar with. Estate taxes, okay, inheritance taxes, okay, so which means that there is a limit up to which you are not, you don't incur what's called the death tax, okay, so $5 million is the limit, okay, for a single person, okay, 10 million if you're married, so up until you reach that net worth, okay, you don't pay tax on that money up to $5 million until you, and then if you pass away, your estate gets that money, okay, and it is passed to the estate tax-free. For every dollar that's over the $5 million, you get taxed at an exceptionally high rate. Okay, inheritance tax at the state level. Well, at the state level, and it varies state by state, but in the state of Maryland, it's only $1 million. So even though the federal is giving you a $5 million exemption, the state's only giving you a $1 million exemption. Okay, so once you get to that point, or your parents or your grandparents may be at that point, there are definitely planning strategies that need to be considered. And then finally, the tax that we are all familiar with, okay, the tax on our earnings. So income tax, both at the federal and at the state level. And then we also have Social Security taxes that we also pay out of our paycheck. So the second learning fundamental is how do we go about calculating what our taxable income is, okay? And subsequent to that, how do we, once we know what our taxable income is, how do we figure out how much we're actually going to have to owe in terms of federal income tax, right? So back in late 2017, all right, the Tax Cuts and Jobs Act was signed, into law. And there was a lot of reductions in certain tax rates for certain taxpayers. There was larger deductions for some taxpayers. They also limited some of the more commonly used tax deductions like mortgage interest, other items that unless you itemize your taxes that you really no longer get a chance to take advantage of. Charitable contributions, they got rid of the line item deduction for charitable contributions, but they rolled a lot of those deductions into a higher exemption number, and we'll talk about what that means in a second. So, right now they're permanent because they are signed into law. However, depending upon what happens with the upcoming election or future tax law changes, what we see today for 2019 tax return, 2020 hasn't been published yet, obviously. What we see today may not be what exists 3, 4, 5 years down the road, okay? Which is why, getting back to that first learning objective, it's very important that you stay kind of in touch with what's happening in terms of the rules and regulations when it comes to tax reform. So when we think about going into determining what we call the adjusted gross income, all right, the final number, okay, that we look at before we start taking into account standard exemptions in order to calculate taxable taxes due, taxable income, okay, in the next couple of steps. So the first step in determining your adjusted gross income, or AGI, okay, is the end goal is to determine what is our taxable income, okay? It's net income, right? After all the deductions, okay? That is the number from which we calculate our income taxes, okay? The tax that is due, right? So the first step is we got to determine AGI, right? And when we talk about determining AGI, we're aggregating a lot of different numbers, okay? We're taking our W-2 wages, right? The money that we earned, okay, from the jobs that we have, okay? Any sort of tax-exempt interest that we may have earned. Maybe we own some municipal bonds that we receive tax-free interest on, okay? Interest and dividend payments, okay? The interest that you earn within your bank account, your savings account at whatever institution you currently bank with, that's taxable income to you in the form of a 1099, okay? So then what we have are dividend payments, right? Dividend payments that you receive from owning investments, okay? If you have a, $10,000 investment account and you have that $10,000 invested in a company that pays you a 2% dividend yield, okay? You earn 2% times $10,000 or $200 a year of dividends. Okay, that's income that you're receiving. Even if you reinvest those dividends, doesn't matter. You are receiving income from a third party. And that dividend interest, that dividend payment that you receive, is taxable income to you. So we have to factor in dividends. Okay. This one isn't applicable to you yet, but it might be for your grandparents. Income that they're receiving from their IRA. Okay, if they're taking distributions from their IRA to support their lifestyle, okay, that flows into their 1040 as taxable income. Okay, and then we have other types of income. If you own your own business, right, so you've got profits from a business that flow in through additional income. If you receive alimony payments, okay, maybe you sold some investments that had some gains. Those gains flow in. Maybe you sold some investment that had some losses. Those losses can go to offset some of those gains that you may have had. So the point here is that we're taking all of our income through many different sources, okay? Whether it's our personal or whether it's through business or any income stream that we may have had, we're aggregating all of that to determine, okay, what our adjusted gross income is. Okay, and when we get to the 1040 form, you'll see how this works. Okay, so once we know what all of our income is, now we have to look at what kind of adjustments to that income we might have. Okay, did we pay student loan interest? Did we make contributions to our employer-sponsored retirement plan, qualified plan, AKA 401k plan. Okay. And we'll go through Schedule 1 to see what some of those deductions look like. So once we have our adjusted gross, then we remove all of those deductions, those adjustments to income from Schedule 1. And then we get to our actual adjusted gross income, from where we've taken all of the income streams that we've got. We've adjusted that based upon all the different streams of money that we had flowing into our financial life. We take all those adjustments that we make, and then that final number, after we've done those two things, that is what we call our adjusted gross income. Okay, and at this point, we have a decision to make. Okay, this decision right here. Okay, the IRS allows us to make a choice. We can take what's called the standard deduction, and I'll show you what that is when we get to the 1040, because it varies depending upon the filing status. Okay, whether you're single, whether you're married, whether you're a single head of household, it's different. But you can claim standard deduction. And then all you do is you claim standard and you write the deduction down, and then you move on down the line for the income tax calculation. Alternatively, if you have a list of deductions, which is what we call itemizing, meaning you've kept a folder throughout the course of the whole year with all of the expenses that you incurred that could relate to a deduction on your income taxes. And when you tally up all of those expenses, if that list of expenses is greater than the standard deduction, maybe you want to go ahead and itemize. Okay. The Jobs Act in 2017 was put in place in an effort to eliminate the vast majority of people who itemize. Okay. And they adjusted up the standard deduction in order to compensate for that loss of potential itemization. Okay, so the vast majority of folks now will select the standard deduction as opposed to the itemized deduction. So that's what we're going to do in this class. I'm not going to teach you about itemized deductions. We're just going to flow through the standard deduction, because for the most part, at least for the first 5 to 8 to 10 years after you graduate, that's the direction you're going to be going. Okay. So we have our adjusted gross income, and then we're flowing down and we take out our standard deduction. And then if we've got any qualified business income deductions, we'll strip those out. Okay. So if you own your own business in the future, like I do, there are certain things that you're capable of deducting off of your taxes that relate specifically to the operations of your business. Okay. As it should be. Right. And then once we do that, once we've taken our AGI and we've backed out the standard deduction, and we've then backed out any qualified business deductions, okay, that gets us to our taxable income, right? And that is where we calculate what our taxes owed are using the marginal tax tables, okay? Once we've done that, we calculate how much tax we owe, right? If there's any other taxes that we might have, we'd obviously add that to it. Okay. And then at this point, if we've received any tax credits, okay, which maybe you've seen in terms of buying an electric vehicle. Sometimes the federal government will incentivize people to purchase EVs by offering a $3,500 tax credit, okay? That tax credit is a bottom line literal credit off of the taxes that you might owe. And even if you were getting a refund, okay, that tax credit simply adds another $3,500 to whatever refund you might be getting. Okay, so there's a difference between tax deduction and tax credits, right? Tax deductions flow in up here prior to the calculation of your taxable income. So it essentially lowers the amount of tax that you would eventually have to pay, but it is not a one-for-one offset or addition like tax credits are. Okay, so a very important distinction there between a tax deduction versus a tax credit. And then finally, at the end, that tells us what our taxes due are, okay? If we owe money or if we're getting a refund, okay? So this equals total tax due. That could be a positive or a negative number. If you owe tax, you got to cut a check to the IRS. If you are getting a refund, they will put that money direct deposit right into whatever account you choose. So when we think about income, we've got different types of income that are included in gross income. We've got obviously our earned income, that's our W-2 wages, the W-2 form that you get from your employer, right? And we've got investment income or portfolio income. So that's money from dividends, interest, or rent from investments that you might have. And we have things like passive income, right? Maybe you're a limited partner in a partnership where you're not responsible for the day-to-day activities of the business, but as a return to you for investing in the business, you receive some sort of passive income. Okay, you receive a portion of the money that partnership makes simply because you're an investor in that business, but you're not actually participating in the day-to-day. So it's a passive investment for you. Okay, and then like we talked about, there's other income, alimony, any sort of bonus awards that you might get, lottery winnings. Okay, we can all hope for that one day, right? Gambling winnings. Right? Then we have things that are excluded from gross income that are not going to be included. Okay, there's a portion of some foreign earned income that doesn't go into this calculation, right? And we've got some tax exempt items, possible municipal bonds that could be triple tax exempt. Okay, owning treasuries. Okay, so there are different types of investments that can generate tax-free income for you. Okay, doesn't come without risk, and we'll talk about that later in the semester when we get to talking about bonds and stocks and valuations and mutual fund and ETF analysis and stock and equity selections. Then we have other items like tax-deferred income. Okay, items that are going to be taxed at a later date. So contributions that you make to an individual IRA, a traditional IRA, okay, can be deductions for your current year taxes. Right? Not a Roth IRA, but a traditional IRA. Okay. And then we get to this item of adjusted gross income. So it's the gross income after we've accounted for certain deductions / reductions. And then once we've adjusted all of those earnings, okay, for contributions to an IRA, whether you've had to pay any penalties because you took money out of your IRA early, if you've received alimony payments, all these things, okay, and those adjustments, we take care of a lot of these things within Schedule 1, okay, and we'll look at Schedule 1 so you can see what that looks like, because you're going to need to complete that for the case study that's due next week. So a tax deduction, once we get into computing taxable income, we're allowed to take some deductions. Okay, the federal government says, we know you've got a lot of things that are going on in your life. We know kids are expensive, right? So we're going to give you kind of a standard deduction, a tax deduction, okay, that you can subtract from your adjusted gross income in order to arrive at your taxable income. Okay, and like I was saying, the vast majority of folks that are your age and for the foreseeable future are simply going to subtract the standard deduction from your adjusted gross income. Okay, so we're not going to spend a lot of time talking about itemized deductions, but you should know that that option exists, okay, such that as you move through your life cycle and your situation changes, you're aware that there may come a time where itemizing your taxes is the route that you want to take. But right now, we're just going to deal with the standard deduction. Okay. Okay. And then we talk about exemptions, right? So prior to 2018, okay, the IRS would allow you to take an exemption for yourself, okay, which was a deduction from your AGI. You could also take an exemption for your spouse, and you could take an exemption for each of the children that you might have, okay? But when the Tax Cut Jobs Act was put in place, all of that was done away with, and the standard deduction was increased significantly, okay, in order to compensate for those former exemptions on the tax form. Okay. So after we've taken our AGI and we have looked at our standard deduction, okay, so AGI minus standard deduction, okay, now we get to our taxable income. So here's an example of our taxable income, right? We've got gross income, right, of $81,050. Okay. We are removing some adjustments to our income. We made some contributions to our retirement plans in the amount of $4,500. So we can take that out. Okay. It's a tax-free, a pre-tax contribution, okay, which gives us our adjusted gross income of $76,550. Okay. So gross income, we've taken all of our wages, all of our profits, all of our dividends, all of our interest, any other income. Okay. That's the 81,050. We've taken all of our adjustments to income that we're going to look at Schedule 1, totaling 4,500. We can remove that from the 81,050 and we get to 76,550 as our adjusted gross income. Okay. We're going to take the standard deduction. Okay. We're not going to itemize. We're going to take standard deduction of $24,000. Once we take the $24,000 away from our AGI, that gets us to our taxable income. Right? This is the number right here, right, that our taxes are calculated upon. Okay. So how do we go about calculating what the taxes are that we owe? Okay. Well, it's fairly straightforward, right? But it can get a little bit messy. Okay. So unlike the corporate tax rate, which was also changed back in 2017, and it just went to a flat 21%, our personal taxes still get calculated on what's called a marginal basis. Right? We are taxed on the next dollar of earnings, okay, that we make. Right? So for example, if after all of your deductions, you find yourself in the 28% tax bracket, which means that you're going to pay 28 cents in taxes, right, for every dollar of taxable income in that bracket, okay? Not 28 cents in taxes for every dollar that you've earned, but 28 cents on every dollar that you've earned in that tax bracket, okay? In addition to all of the former layers of taxes getting you up to that point. So let's take a quick look at an example here. Okay, so here are the marginal tax tables from 2019. Okay, and as you can see, we've got the marginal tax rates down the side. Okay, so we're just going to assume for a second that we're filing in a single status. And we're going to assume that we have a job, our taxable income that we calculated was that $52,000 that we saw on the previous slide. Okay, so the first thing we have to do is we have to go see, we're filing in a single status. So we have to see now which marginal tax bracket does that $52,000 fall within. Well, it's above 9,700. Okay, so we're not in the 10%. It's above 39,475, so we're above the 12%, but it's not above the 84,200. So their 52,000 falls in this range, all right? So the 52,000 falls between 39,476 and 84,200. Therefore, you are in the 22% marginal tax bracket. Okay, so again, that doesn't mean that you face a 22% tax on all the dollars that you earn. You face a 10% tax rate on the first $9,700 that you earn. Okay. You face a 12% tax on the difference between 39,475 and 97,001, which is 29,775. Okay, so the whole difference in this bracket, you have to pay tax on this whole bracket, and the difference between this number and this number is 29,775. So 29,775 at 12% tax, in addition to 10% of 9,700. And then the third layer of tax that you owe relates to the 22% tax bracket for the dollars that exist within that tax bracket. Okay. which would be if you take 52,000 and you subtract it out from 39,476, you're looking at 12,524, which means that $12,524, so 52,000 minus that, 12,524 at 22%. Okay, so you have 3 layers of taxes. You have the dollars of tax that are owed in the 10%, dollars of tax that are owed at the 12%, then you have dollars of tax that are owed within the 22%. And the addition of those 3 layers gets you to the total tax that is due. Confused yet? I bet. So let's move on to an example so we can see how this actually works. So we have calculated that our taxable income is $50,000. Okay, so we're going to file in a single status, and here are our ranges for the different tax brackets. So the 10% bracket goes from $0 to 9,700. The 12 goes from 9,701 to 39,475, and the 22 tax bracket goes from 39,476 to 84,200. So let's build the layers. Okay. So the first, we've obviously made more than 9,700, right? So our taxable amount is $9,700. Okay, our taxable amount is $9,700, and the tax that's owed on that $9,700 is $9,700 at the 10% rate. So we owe $970 from that first layer of tax. Now let's move to the second layer. Well, we know that our salary, our taxable income, is higher than $39,475, so we know we're going to have to pay tax on that entire bracket. So the taxable amount is the entire bracket, or $29,775. We owe tax on that entire tax bracket. So $29,775 at 12% gives us $3,573 in tax that is due from the second layer of tax related to the 12% marginal tax bracket. Okay. Now we're in the marginal tax bracket that our taxable income falls within. So how do we calculate this? Well, we take our $50,000 minus the lower end of the bracket, and that difference gives us the taxable amount that is due, okay, within the 22% tax bracket. So we take the taxable amount that falls within that 22% tax bracket, multiply it by 22, and we get our third layer of tax of $2,315. Our total tax that's due is the sum of 3 layers, the 970, the 3573, and the 2315. So we're taxed on a marginal basis. We're taxed on the next dollar that we earn. The more money that we make, the higher that our taxes are going to be. So our total tax due is $6,858. Now this gets us into the concept of average tax rate. Okay. We know what our marginal rate is, right? We know that our $50,000 of taxable income falls within the 22% marginal tax bracket. So our marginal tax rate is 22%. Okay. But our average tax rate is not 22%, right? Because we've got tax that came in from 2 brackets lower than 22%. So 6,858 divided by our taxable income gives us 14%. So our average tax rate is the total tax that we paid divided by our taxable income. Right? And if you think about it, that means that the average tax rate is always going to be less than the marginal rate, right? Because no matter how much more money you make, your marginal tax bracket is always going to go up. But that final tax that's due is going to be a compilation of all those marginal tax brackets below that higher tax bracket that you find yourself in. Okay, so your average rate is always going to be less than your marginal rate. Okay, so we just talked about it. A person's average tax rate is based upon the total tax that's due divided by the taxable income. Right? And the average tax rate is less than a person's marginal tax bracket, except for one point, except if you find yourself within the 10% income bracket. Okay, if you find yourself within that bracket, because there's only one layer of tax and because the tax that's calculated is entirely related to that singular layer of tax, then your average tax rate is going to be equal to your marginal tax rate, okay? But you guys are going to a fantastic institution, and so somehow I feel like you're not going to find yourself solely in the 10% tax bracket. Tax credits, right? Again, difference between tax deductions, which we've talked about, and tax credits. Tax credits are a one-for-one offset to whatever tax is calculated in this scenario, okay? So in this example, if we have a $6,858, okay, that are due in taxes, all right, and we get a $3,000 tax credit, okay, from the government for buying that fancy Tesla or, you know, BMW i3, okay, or i8 if you're lucky in your future, okay? And the government says, thank you for buying such a, you know, green vehicle, we're going to give you a $3,000 tax credit as a result of that, okay? The credit comes off of this number, okay? So if you do this math and you owe $6,858, okay, and the government's going to give you $3,000, okay, then that comes right off this number, and you no longer owe the government this, you owe the government this minus $3,000. Okay, so it's a one-for-one offset. A very important thing to keep in mind, because when we get to the midterm, okay, the case study that's for the midterm, you're going to have something like that. You're going to have a tax credit that you're going to have to account for. Okay. And there's a whole host of types of tax credits that you can experience in your future, from child and dependent care expenses, moving expenses, alternative motor vehicles, energy savings, mortgage interest, you know. But for the most part, when we deal with tax credits in this class, I'm going to keep it really simple, and it's going to be related pretty much to this alternative motor vehicle, because it's just designed to expose you to the mechanics of how to go about implementing a tax credit within your tax filing. Okay. Tax payments and deadlines. All right. If you own your own business, you know, like I do, you know, we're required to make quarterly tax payments. Okay. Estimated payments that, you know, we think we're going to incur over the course of a 12-month period of time. Okay. A lot of people have to make estimated tax payments. All right. How it goes about, you know, being determined as to who does and who doesn't, that is definitely more of a question for a CPA or other accountant. But nonetheless, you know, we fill out a W-4 form when we get our job that kind of gives the government an idea of our tax filing status and the number of dependents that we might have living in the home, okay, what our annual income looks like, and then based upon what we submit on that W-4, okay, then the payroll system that your companies have then determines how much federal tax gets taken out, how much state tax gets taken out, fixed percentages for Medicare and Social Security. Okay, so the withholdings that you see from your earnings statements relate specifically to what you submit on that W-4 form to your employer. Okay, taxes are due April the 15th. Okay. You can file an extension. Like I pretty much file an extension every year simply because I own my own business and my tax returns aren't necessarily 100% complete on the day that they need to be filed. So I can file an extension for 6 months, which gives me until October the 15th to formally submit everything to the IRS and to the state. However, if when you prepare your filing, you still have to file on April the 15th, even if you're going to file for an extension, you still have to transmit your tax return on April the 15th. And if in the process of completing that April the 15th filing, you experience that you owe the government money, you still have to write the check on April the 15th. You still have to pay the government the money on April the 15th, okay? Unfortunately, if it's the other way and you're going to your forecast to get a refund, the government's not giving you any money, okay? They'll wait till October the 15th to give you money, okay, if you're filing an extension, which seems a little odd, but that's just the way it is. The government doesn't surprise me much anymore, okay? So here's your W-2, all right, just an example for this nice lady, Barbara Victor, okay? And we go through some information on the W-2. which is important because when we get to the W-2 and how we translate the W-2 onto a 1040, okay, a lot of the information here is important. Okay, so some of the obvious major categories is one, what are our wages and tips? All right, I'll show you exactly where that number goes, okay, in terms of on the 1040 itself. Okay, how much federal income tax was actually taken out of her paycheck? Okay, this will kind of go into determining whether we're going to get a refund or whether we're going to get a situation where we've got to owe the government money. What wages are being used for Social Security? Okay, and the difference there, okay, the difference there is $7,000, which is the addition of what's down here. So we got some deductions from a federal tax standpoint, all right? And so we've got, what we have there is the Social Security wages are calculated based upon our gross wages before any pre-tax deductions are taken out, okay? Same thing with Medicare. So we have the Social Security tax that was taken out and we have Medicare tax that was taken out, okay? It tells us what kind of plan, what kind of qualified plan that we were making pre-tax deductions into. So that's a retirement plan. Gives us the employer identification number, okay, for her company, Information Data Inc., and where they're located. Okay. For the state information, it tells us what Information Data's ID number is with the state of New Jersey. It tells us what the state wages are, all right? And the state wages are the same as the federal wages. And then how much state income tax was taken out, okay? We'll talk a little bit more about what's going in here to these boxes, all right, once we get to the tax return. But nonetheless, the majority of what's going to get put in for your income is going to kind of come off of your W-2. So filing a federal tax return, all right? What we need to look at here is we have to choose a status, okay? Every citizen of the United States or Puerto Rico is required to file a federal income tax return if your income is above a certain amount, okay? And that amount is based upon your filing status with the IRS and your age. So we've got 5 different filing statuses. We've got single, that's fairly obvious. We've got married with a joint filing, okay? We've got married, but we're gonna file separately. We've got head of household, which you're an unmarried individual, but you've got dependents that live with you, whether that's a child or a dependent relative. And then you've got qualifying widow or widower. So you've got 5 different options to choose from. So the vast majority of you are going to be selecting single for the first few years and then possibly moving into either option 2 or option 3 based upon your own personal situation at that time. And then possibly down the road, I'm in a situation where I file head of household because I'm, unmarried, right? But I have dependents. Okay, so I'm able to file head of household. So in years past, it was a little confusing as to what form that you needed to go select in order to complete your taxes, right? But there were 3 basic forms in years past prior to the Tax Cut and Jobs Act. You had the standard 1040, you had a form called the 1040 EZ, which was if you were just going to take the standard deduction and you didn't really have any crazy tax things going on, you could file this 1-page form 1040 EZ, and then you had a 1040A. Now, there's only one form, okay? It's the form 1040. They simplified the form, they consolidated the 3 forms down into one. However, that's great, and it simplifies the life of folks who file under very similar and simple tax circumstances. Okay, so what you need to know is that there are still about 800 other federal IRS tax forms that sometimes get prepared in order to support your ultimate filing on April the 15th. Okay, so when we go about completing the federal income tax return, we need to look at their filing status, the exemptions that we're going to take. We look at our income, our adjustments to income, our tax calculation, Other taxes that we might have to pay, like self-employment tax, okay, which if you own your own business, all right, you are subject to an additional tax. Okay, don't get me started on that. Any tax credits that you've got, if you've made estimated payments over the course of the year, okay, you look at the money that you've already paid to the government in terms of taxes through the course of the year, and then you look at the tax that's owed, you look at the tax that you've paid. The difference between the two is either going to be a refund or amount that you owe to the federal government. Okay, and then finally, don't forget to sign your tax return. This is the biggest reason for tax returns to get rejected. Not so much any of all the other things that go into it, just people forget to sign their returns, okay? So sometimes you made a mistake and you've got to go back and you've got to correct the mistake, all right? Form 1040X allows you to do that, okay? Filing your income taxes for the state, very similar. And there's only 7 states that don't have state taxes, which is awesome, all right? The great state of Texas being one of them and the sunshiny state of Florida being the other one. One of those 2 states is where I plan to end up in retirement. Okay. The state tax ranges range anywhere from 1 to 10%. And it is, again, based upon your adjusted gross income or taxable income based upon your federal tax filing, okay? And you typically will pay your state taxes at the same time that you pay your federal taxes. So it kind of all goes in the bucket at one time. So what I'd like to do now is I'd like to pause for a moment, and I'm going to fire up the IRS 1040 form and an example. And we're going to go through an example of how to go about preparing your 1040. How do we use the 1040 form? How do we use the W-2? How do we use Schedule 1, okay, in order to determine what our taxable income is? And then subsequent to that, how do we determine what our taxes due are using the marginal tax tables? Okay, and then finally getting us down to how much do we owe, how much did we pay, okay, and to see whether we're going to get a refund or whether we're going to owe money to the federal government. So we're going to walk through an example, because an example very similar to this, okay, is what you're going to see in that case study that's going to be due next week. Okay, so I'm going to get this fired up, and I'm going to come back with a second part to this session through a separate video on how to go about completing your tax form.